All right, let's jump right in. When the stock market tanks, the harsh reality is that, well, most people completely panic. They watch their portfolios drop, they doom scroll through this endless stream of terrifying breaking news, and ultimately, they run for the exits. They sell everything out of pure fear. But here is the truly fascinating part. While the masses are panicking, the wealthy are often doing the exact opposite. History consistently shows us that some of the absolute biggest fortunes in the world weren't built during the boom times, but during periods of absolute market chaos. So, in this explainer, we're going to unpack the actual mechanics behind this. And honestly, the strategy is surprisingly simple. So, you've got to ask yourself, what do rich investors know that most people don't? How can they look at the exact same terrifying headlines that we all see, but instead of panicking, they see a clear-cut path to building wealth? Today, we're bridging that gap between the fearful public reaction and the highly strategic playbook of the ultra-rich. Let's find out exactly how they pull this off. All right, Chapter 1, the chaos versus the calm. Look, as humans, we are literally wired to run from danger. It's just biology. So when markets start free falling, fear takes the wheel, and suddenly cashing out your investments feels like the only safe move. But that's the tragic flaw right there. Everyday investors tend to sell off after prices have already plummeted. Think about it. It's basically the equivalent of returning a brand new TV to the store just because it went on sale. By panicking, they lock in those temporary losses, they stay out of the market way too long, and they completely wreck their long-term returns. The wealthy, though, they understand a crucial truth. Market crashes are temporary, but panic causes permanent damage.
Which brings us to Chapter 2, The Great Discount.
It's a complete night and day difference in mindset. While the crowd is hyper focused on falling numbers, wealthy investors are looking purely at value. Picture this. Imagine your absolute favorite luxury store suddenly slapped a 30% off discount on literally everything inside. Most people would rush in and buy as much as they could carry, right? But for some reason, in the stock market, people do the exact opposite. They get scared and run away. Rich investors just see a market crash for what it actually is, a massive luxury sale. High quality businesses get cheaper. Great assets are suddenly heavily discounted. These are golden opportunities that simply do not exist when the market is booming. So instead of joining the crowd and asking, oh no, how much am I losing? They step back and ask, okay, what can I buy at a massive discount? Moving on to Chapter 3, the Strategic Playbook. This is where preparation meets opportunity. The main reason the wealthy can actually capitalize on these crashes is incredibly straightforward. They are ready for it. Step 1, and this is a big one, they maintain healthy cash reserves. And they don't hold cash because they're afraid of the market, they hold it because they know huge opportunities are eventually going to pop up. Step 2 is identifying those sharp declines when public panic really sets in. And step 3, deploying that capital at those bargain basement prices. When the market tanks, they already have a war chest ready to go. Without cash on the sidelines, regular investors are usually stuck just watching generational wealth building opportunities pass them right by. Preparation gives the wealthy flexibility, and flexibility is a massive, massive advantage. Now, you might be wondering, what exactly are they buying with all that cash? Well, during this big sale, they completely tune out the hype. No speculative gambling. They are hunting for quality assets. We're talking about companies with massive profits, iconic brands, bulletproof balance sheets, and serious long-term competitive advantages. Because during a crash, weak businesses tend to crumble, or even go under entirely. The rich know this, so they don't roll the dice. They focus purely on the premium, blue-chip quality that keeps the whole economy running. And they stick to those assets for one very simple reason: quality survives. History proves time and time again that truly great businesses don't just recover after a crisis. Market leaders actually emerge even stronger. They have the resources to adapt and thrive, while their weaker competitors basically just fold. Let's look at Chapter 4, the power of time. Time frames change absolutely everything here. The average investor is thinking about the next week or maybe the next month, right? They're constantly refreshing their portfolio apps, stressing over daily dips. The wealthy, on the other hand, they are thinking about the next decade. When your investment horizon is measured in years instead of days, a market crash looks entirely different. Up close, yeah, a sudden drop looks like a terrifying cliff. But zoom out to a 10-year horizon, it's literally just a minor speed bump. Just watch how this practically plays out across a full market cycle. Over a span of days, you get that sharp, panic-inducing decline. Then, over the next few months, the strong businesses start adapting to the chaos. Give it a few years, and the markets fully bounce back. Give it decades, and the patient investors, they are massively rewarded. Wealthy investors understand this rhythm. They know that every single major economic crisis in history has eventually ended. Markets always recover, and the people who stay calm are compensated handsomely. And finally, Chapter 5, the ultimate advantage. You might be surprised to hear that the greatest tool the wealthy have isn't actually their bank account. It's their own psychology. It's emotional discipline. Fear causes terrible decisions. Greed causes terrible decisions. And the most successful investors have learned to actively manage both. When things crash, they don't ignore the risks, but they absolutely do not let their emotions steer the ship. Instead, they stick to a pre-written plan, they rely on cold, hard data, and they stay fiercely focused on their long-term goals. Because at the end of the day, managing your own mind is way more valuable than raw intelligence when it comes to investing. It all really boils down to this. Market crashes create fear, for sure, but they also create incredible opportunity. Every economic crisis gives us a dual reality. The crowd only sees the red arrows, the losses, and the panic. But smart, wealthy investors, they just see value. They prepare early, they keep cash handy, they scoop up quality assets, they think in decades, and above all else, they keep their emotions in check. So the biggest takeaway from all of this is pretty simple. The next market crash is coming. History practically guarantees it. The real question is, when that chaos finally hits, what are you going to do? Will you react like the fearful crowd and lock in permanent damage? Or will you think like the wealthy and use that exact same chaos to build your own fortune? The choice is totally up to you. Just make sure you keep this playbook in your back pocket for the next great discount.